You have to value the business. And
as a follower of Ben Graham, what one piece of Graham's advice would you say has had the most impact on you?
Well, you can't get rid of one leg of the three-legged stool and still have a good investment philosophy. But I would say that the most important thing over a long period and working with big money is to understand the business. I mean, let's just say for the moment that you were given $1 million or whatever sum was necessary, and you could look around Knoxville, or look around all of Tennessee if you want, and buy into any three businesses, between now and a week from now, private businesses. So they're not trading or anything of the sort. And you've got a week to do it, or you have to give the money back. Now, what will you be doing during the next week? I mean, you can look at all these companies. Some of them you're quite familiar with. Some of them you're less familiar with. Some of them you know by reputation. Some of them you know the management. Some of them you don't. You know their competitive situation. What will you be thinking about during that 7-day period? How will you actually be screening these companies out? I think you're going to be looking for businesses that have enduring competitive advantage. You don't want to buy a Burger King franchise just because nobody's come within 10 miles of it yet, because Wendy's and McDonald's and all of those will be there pretty soon. I mean, it isn't necessarily who's earning the most money now. You're going to look for something with enduring competitive advantage. Now, that takes a business with some kind of a moat around it, because capitalism, by definition, is a system where every time somebody has an economic castle, somebody else is going to come after it. I mean, it's just the nature. If you open a restaurant that's successful here in town, somebody's going to take your menu and probably take your chef, maybe cut your price, maybe offer a little more parking, maybe be a better okay, whatever. I mean, capitalism consists of going after the other guy's castle. Now, if that's the case, you want a castle with a big moat around it. And there's a lot of ways you can have a moat around something. You could have it by patent protection. You could have it by location in certain areas. I mean, if you have something in people's mind, like Coca-Cola, 6 billion people in the world, practically all of them have something in their mind about Coca-Cola, largely favorable. They're going to sell a lot of Coca-Cola. And it won't make any difference if somebody is a half a cent less on some serving than Coke. So that's an enduring competitive advantage. And you want it run by honest and able people. You don't want to go in with a crook, and you don't want to go in with a dope. Now, the best businesses to buy are the ones where you could have a dope in there. I mean, Peter Lynch says, buy a business that's so good that an idiot can run it, because sooner or later one will. And there's some merit to that. Those are the kind of businesses to own. So you want a management that's able and honest, and then you want a price that's sensible. And that's what you'd look for. You'd go around Tennessee, got a week to do it, and you'd immediately screen out a whole bunch of things. You just know that they weren't a fertile area, And that's an important thing to be able to do, to know, just get rid of all kinds of things. There was a great article in the New Yorker 30 years ago when Bobby Fischer was playing Spassky in that famous chess match which drew attention around the world. And they examined how the mind could, with billions and billions and billions of possibilities, how it could group things so as to immediately cast it down to where you had like 4 options. And of course, when the humans play something like deep thought, or whatever the latest version is of the computer on that computer is making maybe 700,000 or 1 million calculations a second. And the human mind is competing against that. But the computer is checking every possibility. And the human mind somehow has this ability to cast out 99.999% of those things that the computer has to go through in order to focus on the 3 or 4 possibilities that really make sense. And investing's a lot like that. It's not that tough because there aren't that many companies, but you want to cast out all kinds of things. If somebody told me that my life depended on picking among the Dow Jones stocks a group of 10 that would be the best performers or outperform the index as a whole, I would spend my time thinking of the worst companies in there. I would cast out things, and then I would figure I left those behind, and I would. That's an easier way to approach the problem actually, than trying to pick the 10 best. So you would have to, if you were thinking about the state of Tennessee, there's a whole lot of things you wouldn't examine. You just figure they're too tough. You might decide, car dealerships were too tough. It's always going to be competitive. Who knows whether Ford or General Motors are going to be selling more cars 5 years from now, or whether there's going to be tariffs on foreign cars, or who knows. So you just say, I'll give up on car dealers. That approach that you use there is the same approach you really want to bring to the stock market. You've got 3,000 companies tonight you can look at on the New York Stock Exchange. You don't have to play. Once a year, if you have 5 good ideas in your lifetime, you get very rich. Third thing in Graham's book is the margin of safety. If you come up to a bridge and it says capacity 10,000 pounds, and you're driving a 9,800-pound truck, you drive down further and find another bridge. I mean, nobody knows exactly what that capacity is, and sign may have been put up 3 years ago. So you always leave a margin of safety. You don't try to cut things that close. You wait till something kind of shouts at you in the stock market. If I get an idea about looking up a company, and I get the 10Ks and so on, I would rather not know the price, because I'd rather value it without knowing the price. A stock is part of a business. You value a business, and then you divide by the shares outstanding. But what you have to think about is what kind of a business are you getting into, what are its economic characteristics, who are its competitors, what's its management like, all of these things that relate to a business instead of a little ticker symbol. And you can build all kinds of structures on that, but that's the foundation. And if you've got that in mind, and that's in the intelligent investor, I've never found anything that remotely compares with it.
We have to deal in things that we're capable of understanding. And then once we're over that filter, we have to have a business with some intrinsic characteristics that give it a durable competitive advantage. And then, of course, we would vastly prefer a management in place with a lot of integrity and talent. And finally, no matter how wonderful it is, it's not worth an infinite price. So we have to have a price that makes sense and gives a margin of safety considering the natural vicissitudes of life. That's a very simple set of ideas. And the reason that our ideas have not spread faster is they're too simple.
One thing you're trying to do is say, of all these public companies out there, here's the company I really like. The fundamentals are terrific. Their earnings are doing well. Their competitors are doing poorly. I think this company's doing terrific. And all of a sudden, the stock might have gone from 40 to 30 because of this decline. That would say, wow, here's a chance to buy it. So you're trying to say some companies might have been overpriced at 60, and all they did was go to 50, and you say, big deal. So you're trying to find companies you liked anyway. Right now you liked them, and now they've had a haircut. That's what you would do. Not a stock that went from overpriced to fairly priced. Something that was fairly priced at the start of this exercise, and then had a very, a 5-for-4 sale.
If you had been managing the Magellan Fund this morning, you would have been buying like crazy?
I would have been researching like crazy. I would have been saying, which companies are the same story? Is there anything really happening? This is a non-event for them. They're still doing well. Even if we have a recession, there's nothing to do with them. And that's the kinds I would try to buy. But let's say if a company, just think of this as being, you say to yourself, I think this company's going to earn something in the future. If it's already discounting that, if it's selling at a huge multiple, you say, it has to work. And then it's only going to stay even. So you have to say to yourself, if I'm right, how much am I going to make? If I'm wrong, how much am I going to lose? That's the risk-reward ratio. In Stock Shop, we talk about, if I'm right, I hope I'm going to double, triple my money. If I'm wrong, maybe I'll lose 30, 40%. That's a favorable ratio. You say, if I'm right, the stock's not going to go up. It's already discounting terrific things. If discounting terrific things are already in the stock, I don't want to own it.
Okay, so this morning you get up and you go in and you look at those companies that fit
that you know something about. You have to have an edge. I mean, let's say the cement industry goes from crummy to semi-crummy to fairly good. The stocks are going north.
Right.
You're going to make money. That's the industry you know. What if you know the publishing industry? Some people you have an edge. You work. I mean, what if you last 30 years you worked in the restaurant industry? You would have seen Taco Bell.
Right.
You would have seen Sbarro's. Right. You would have seen Pizza Hut. You would have seen Chili's. You would have seen these companies doing very well. You should have bought those instead of trying to buy biotechnology stocks you know nothing about. I mean, I know nothing about local area networking. A lot of people are buying this Cisco. They're buying the equipment, saying, we're going to root together all these peripherals and put together the servers.
Well, but that's not a bad buy because they own a huge percentage of their market.
You know what, they're saying only a few people had them. I said, my God, if it works for us, other people will try it, then colleges will try it, high schools will try it, then they'll go overseas. They knew they were early in the ball game.
Right.
And they should have been buying that company instead of out buying something they don't know anything about, some oil drilling company. I mean, people have this tendency to always buy something they don't. All you need is a few. Charlie, all you need is a few good stocks a
Yeah, but
decade.
this is your song. This has been your song for a long time.
but
Only
here's the
buy
point.
what you know.
No, but people are waking up in the morning and say, there's 5,000 companies out there. Which one should I buy? The average person ought to be able to follow 4 or 5 companies. They ought to be able to lecture on them. So you can say, this is a company I want to look at, and I want to see what their cash looks like. And if you don't understand what cash is, if you don't understand what debt is, I always said, let's say you're looking at companies that are doing poorly. They're not doing very well. Why don't you buy the one that has $300 million in cash instead of the one that's almost bankrupt? I mean, a lot of companies are selling at $2 or $3 a share. They might be losing $10 million.
That's a no-brainer, isn't it?
But people don't do it. And
Well, they
with
don't do it
this-
because they don't know how to do the research.
well,
and
this
B,
you can look up the balance sheet. Say, listen, they got $300 million in cash. They're losing $10 million a quarter. They'll be okay.
Yeah.
This other company's got no cash, $700 million in debt. They're about to blow taps.
But you're telling every small investor in America anyway they ought to invest in a mutual fund, aren't you?
I'm telling you, you can do both. You could be investing in mutual funds, and occasionally you should be able to find a stock that's going to make a difference in your life.
If it's an industry you know something about.
Industry or a local company. I mean, there's a lot of people that they sell the Quinta motor inns in Texas. They said, my God, I mean, there are a lot of people have seen local companies. Friendly's. There's been companies come along locally. The people made St. Jude Medical made a lot of money for people.
What was that motel you stayed in and then you went and bought a bunch of it?
Yeah, La Quinta motor.
Was that La Quinta? That's what it was, right? You stayed overnight there
And I
and
also got advice from somebody that was a competitor to this. There's a Holiday Inn guy saying, this guy, boy, they're killing us. They're tough, you know. So that way, you get a lot of information. Don't throw it away.
All right.